Hello, welcome to the channel. Let's delve into some insights and reflections on The Intelligent Investor by Benjamin Graham, widely regarded as one of the best books on investing, as many financial experts have noted throughout recent history. And yes, you read the title of the video correctly. I studied The Intelligent Investor, because the meaning of studying goes beyond the meaning of a mere reading process. It involves delving deeply into the concepts, analyzing the strategies, and applying the lessons to real-world scenarios. This approach allows for a comprehensive understanding of Graham's principles and how they can be effectively used in today's investing landscape. Our meditation on the book will also include thoughts and perspectives from legendary investor Warren Buffett and renowned financial journalist Jason Zweig. Join us as we explore the profound wisdom contained in The Intelligent Investor and uncover how its principles have become timeless. Throughout this video, you'll frequently encounter the term, the intelligent investor, which Benjamin Graham emphasizes as the approach to distinguish serious investors from amateurs or speculators. And here lies Graham's paramount advice: to follow the path of intelligent investments while steadfastly avoiding speculation and herd mentality. Obviously, The Intelligent Investor contains an extensive amount of content that can't be fully covered in a single video. My primary goal was to introduce the key concepts and provide the best examples of Graham's timeless quotes. Graham argues that consistently beating the market is highly challenging due to the unpredictable nature of market movements. History serves as a valuable teacher, reminding investors to learn from past mistakes and successes to make informed decisions. Because history always repeats itself.
Those who do not remember the past are condemned to repeat it.
But don't take it literally. Graham's intelligent investor must never forecast the future exclusively by extrapolating the past. The investor's greatest adversary often proves to be themselves, as emotions and the allure of market trends can lead to self-defeating behaviors. To escape the temptations of the market, the intelligent investor should control the self-defeating behavior that kills most investors, not letting the roar of the crowd override your own judgment. For sustained above-average results, investors should adopt strategies that diverge from Wall Street's mainstream. Independent thinking is crucial. Following strategies widely adopted by others is no longer a guarantee of success. To prosper, individual investors must either avoid popular stocks already heavily scrutinized by institutional giants or hold them with greater patience. Graham also suggested having concrete and realistic expectations.
The whole point of investing is not to earn more than average, but to earn enough money to meet your own needs.
Graham's main intention is to teach how to differentiate investing from speculating, explaining that
there is intelligent speculation as there is intelligent investing. But there are many ways in which speculation may be unintelligent. And by speculating instead of investing, you lower your own odds of building wealth and raise someone else's. It is easier for us to tell you not to be speculative. Hard thing will be for you to follow this advice.
Consequently, the intelligent investor's strength should be that no one has much influence in him. He also distinguishes two ways of approaching the market, related with the concepts of investing and speculating. The first way is related with investing, and it's called pricing. The second way is related with speculating, being timing. By pricing, we mean the endeavor to buy stocks when they are quoted below their fair value and to sell them when they rise above such value. By timing, we mean the endeavor to anticipate the action of the stock market.
The intelligent investor can derive satisfactory results from pricing.
Graham consequently advocates in avoiding speculative timing.
It is absurd to think that average investor could make real money out of market forecasts.
Unless in one concrete situation,
timing is no real value for investors, unless it coincides with pricing. Unless it enables him to repurchase his shares at substantially under his previous selling price.
Apart from the distinction between investing and speculating, Graham also defines two paths for investing: defensive or passive investors and aggressive or enterprising investors. The enterprising investor is not one who takes extra risk than average, whereas is the one who puts extra work, time, and effort in researching his portfolio. For every investor, being aggressive or defensive, what you do not do is as important to your success as what you do. Graham understands the necessity of positioning yourself between these two groups, and this should be the first decision you should make before entering in the financial landscape.
Many investors seek to place themselves in an intermediate category, what most likely to produce disappointment than achievement. You cannot become half a businessman. It is a new world order. We see people discard all the right companies with all the right people with the right vision because their stock price is too high. That is the worst mistake an investor could make.
Don't think you can pick stocks without doing any homework. Finding the promising company is only the first step. Then you must do the homework. He also encouraged to think about what he called the intrinsic financial physics.
A great company is not a great investment if you pay too much for the stock. The bigger they get, the slower they grow.
The intelligent investor gets interested in big growth stocks, not when they are at their most popular, but when something goes wrong, you should always keep an eye on
the relatively unpopular large company.
Graham also manifests his recommendations about looking outside U.S. markets.
If you live in U.S., work in U.S., and get paid in U.S. currency dollars, you are already making a multi-layered bet on the U.S. economy. Be prudent. You should put some of your investment portfolio elsewhere, simply because no one can ever know what the future will bring at home or abroad.
Following Graham's advice, put a prudent small portion of your portfolio also in foreign market.
Every investor who owns common stocks must be expected to see them fluctuate in value over the years.
Graham also estimated that most stocks you own will gain at least 50% from their lowest price and lose at least 33% from their highest price.
If you cannot live with that, then you are not entitled to call yourself an investor.
Graham's concept of Mr. Market is a metaphor used to illustrate the irrational and unpredictable behavior of the stock market.
Mr. Market is always cynical, knows the price of everything and the value of nothing.
Graham suggested maintaining a balanced focus on market quotations and price fluctuations.
The typical investor would be better off if his stocks had no market quotation at all, for he would then be spared the mental anguish caused him by other persons' mistakes of judgment.
One of Graham's main considerations about the market is what he called market premiums.
The development of the stock market in recent decades has made the typical investor more dependent on the course of price quotations and less free than formerly to consider himself merely a business owner. The reason is that the successful enterprises in which he is likely to concentrate his holdings sell almost constantly at prices well above their net asset value, paying these market premiums,
suggesting that investors are more influenced by market trends and less by the intrinsic value of the businesses they invest in.
The better a company's record and prospects, the less relationship the price of its shares will have to their book value. But the greater the premium above the book value, the less certain the basis of determining its intrinsic value.
In this context, Graham's concept of book value refers to the net value of a company's assets as recorded on its balance sheet, explaining that share prices often don't align closely with enterprises' book values, making it harder to accurately assess the company's true intrinsic value, increasing the investment's risk, and consequently paying these market premiums.
A stock cannot be considered as a sound investment merely because it can be bought at close to its asset value. The investor should demand also a satisfactory ratio, earnings price, a sufficiently strong financial position, and the prospect that its earnings will at least be maintained over the years.
These let us introduce the Graham's most important concept, margin of safety.
Margin of safety is the central key point of investing.
Intelligent investors should buy securities only when their market price is significantly below their intrinsic value. This gap provides a safeguard against errors in analysis, market volatility, or unforeseen events, reducing the risk of substantial losses. The larger the margin of safety, the less likely it is that the investor will lose money, even if the investment doesn't perform as expected.
If the price is low enough, create a substantial margin of safety. Security thereby meets our criterion of investment.
Graham finds funds great investment vehicle. But if we're taken some previous considerations,
Investing solely based on past performance of funds is one of the riskiest mistakes an investor can make. Understanding why is so hard to find a good fund will help you become a more intelligent investor.
Here's a recommendation. Hold on to an index fund for at least 20 years, consistently adding new investments each month. By doing so, you're likely to outperform the majority of both professional fund managers and individual investors. However, during the process, when you see your neighbor boasting about their successful stock picks, remember that the primary goal of an index fund is to replicate the market's performance, not to surpass it, and surely over time you will be happier and wealthier than him. To succeed, keep in mind one key factor. Choose a fund that imposes minimal fees.
High returns are temporary, while high fees are merely permanent as granite.
This is Graham's best advice for defensive, intelligent investors. Remember that index funds have only one significant flaw. They are boring. You will never be able to go to a barbecue with your neighbor and brag about how you own the top-performing fund in the country, because you will be having all. If your neighbor asks you if bonds will outperform stocks, just answer, "I do not know and I do not care," because you are automatically buying both. This could be achieved with a permanent autopilot portfolio.
The ideal choice for most investors is a total stock market index fund, a low-cost way to hold every stock worth owning.
Graham also recommends seeking advice from an analyst, but with some concerns.
If the investor asks the analyst the right questions, he is likely to get the right, valuable answers.
The intelligent investor will not do his buying and selling solely on the basis recommendations received from a financial service. Once this point is established, the role of financial service then becomes the useful one of supplying information and offering suggestion.
You hire an advisor not to manage your money, but to manage you.
Graham always encouraged to enjoy the path of investing.
Your lifelong investing voyage should be as safe and confident as it is adventurous. To be an investor, you must believe in a better tomorrow.
Graham finally advocates to develop a comprehensive financial plan and investment policy statement, and adhering to them consistently. By maintaining a clear strategy and following it steadfastly, investors can better manage risks and enhance their chances of achieving sustainable financial success over time. I highly recommend taking the time to study this book yourself. It will greatly expand your knowledge and introduce you to new ways of thinking. If reading the entire book feels daunting, make sure to at least check out Chapter 8 on Mr. Market and Chapter 20 on the margin of safety. They are particularly insightful.
And then I read a paragraph, actually, in Chapter 8, I think it was, of The Intelligent Investor. And it told me that I wasn't looking at the duck, I was looking, now it was the rabbit, whatever it may be. And whether you call it a light bulb, whether you call it, a moment of truth, whatever it may be. And that happened to me in Lincoln. I mean, it changed my life. If I hadn't read that book, I don't know how long I would have gone on looking for head and shoulders formations and 200-day moving averages and the odd-lot ratios and a zillion things. And I love that kind of stuff. Except it was the wrong stuff I was looking at.